It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back to the podcast, Managing Your Financial Future. That's the name of this show. I just heard it on the intro there. This is what we do. We help you manage your financial future. Johnny Dean here, your podcast host, not an advisor. Here with the advisor, Professor Rick Plum, certified financial planner professional. Say hello, Professor Rick Plum.
Hello, Professor Rick Plum.
You're here. We've got a lot of things to talk about and a limited amount of time to do it today.
Yes.
I wanted to get right into this this time. First, because of the new year, or whenever you happen to be listening. But with the new year most often comes new limits and all this stuff. Can we just run down really quickly, like the Roth IRA, traditional, and maybe...
Well, the contributions to the Roth IRA, traditional IRA, they did not change. The only contribution limit that changed was 401k, basically. Salary deferral plans, 401k, 403b, 457. Those increased by 1,000.
So how much can you put in if you're before
20,500 for the less than seasoned adults,
which is the under 50 crowd?
Yes, and if you're 50, it's $27,000.
50 or older, you can put 27,000. I mean,
it was 26, now it's 27.
Well, that's a decent amount. So that's new for 2022. You can still only put in how much to a Roth and traditional?
6,000 for the general population, and then 7,000 for the seasoned citizens of 50 plus.
And then did the income limits change for the Roth IRA?
Yeah, they change every year. They have a little bit of a CPI. So Roth IRAs for a married couple filing a joint return now is 204. If you make less than 204 adjusted gross income, you can do the entire contribution. It's phased out from 204 to 214, $10,000 phase out.
Which, by the way, if you can contribute to a 401k if you have one, and that can bring that income down.
You can bring your adjusted gross income down, yes. So if I'm at 220 and I put in $20,000 into my 401k, now I'm going to show 200 on my tax return if that's the only income I have.
Yeah.
And so now I have the ability to do a direct. There was a lot of talk last year in Congress about getting rid of, at least for some people, and maybe for everybody, the backdoor Roth IRA.
Yes.
That did not pass. And so the backdoor Roth IRA is still on the table and available. So if you do happen to make more than the Roth threshold, and you do not have other traditional IRAs, you can still make a non-deductible IRA contribution and then convert it to a Roth IRA. And
yes.
Now, if you have other traditional IRAs, rollover IRAs, SEP IRAs, simple IRAs, all those other IRA type things, it messes things up.
Well, it does because it becomes a prorated deal, and you can't stick it all in. You'd have to remove all of the money out of those traditional IRAs, which probably defeats the purpose.
Right. But if your income is the same this year as it was last year, and you were just kind of on the limit last year, well, the limits have gone up a couple $1,000s. So, now if you're under 204. You can do a Roth, or was it 128 for a single person?
That's right. We talked married couples
129.
a lot. 129.
129.
Okay. Anything else significantly changed that you can recall as far as contribution?
The annual gift limit went from $15,000 to $16,000.
So you can give anybody you want $16,000
every year,
every single year, and
it doesn't count towards your lifetime gift exemption.
Yeah. So if you have relatives and you love them so much, and you have 20 grandchildren and you want to give every one of them $16,000 for this year.
Last year it was $15,000. This year it's $16,000.
And you can do, and no Form 709 to fill out, and everybody's just happy.
Everybody happy.
Is everybody happy? Yeah. So that's
this marginal changes, nothing dramatic. I haven't seen anything dramatic. Estate tax limit moved up a little bit. They were trying to lower that to somewhere around $3.5 to $5 million. Now it's a little over $12 million.
That's incredible. If you wonder again if people with money have any influence over Congress, I mean, just take a look at the estate tax limits, which have gone from 600,000 or a million way back about 20 years ago. Now they're over 12 million. And yet it was
unlimited in 2010.
Oh, well, of course. Anyway, one last thing before we get into the strategy part of this. RMDs, we had a question from somebody because we talked about this a couple of shows back, that RMDs have changed for the first time in about 20 years. I mean, explain that really quickly. Is it a big deal?
It's not a huge deal. It does lessen the amount that you have to take out each year. If we're looking at apples to apples, if you're talking about $100,000 or $1 million, it reduced the percentage slightly. So for a 72-year-old, somebody who's turning 72 this year, the required minimum distribution as a percentage of last year's balance is about 0.3% less. So it's not it's instead of 3.95% that somebody last year had to take out that was 72, this year somebody who's turning 72 this year only has to take out like 3.65%. It's a little bit less. I mean,
but on a $1 million IRA, I mean,
$300 or $400 difference.
So you can take out $300 or $400 less.
So this only affects people that don't need to take any money from their IRAs and hate paying taxes. I mean, a lot of retirees are taking money out of their IRAs other tax deferred accounts every month, every quarter, every year to live. And just that distribution is satisfying the required minimum distribution. So this is really for people that have pensions or other incomes and they don't need the IRAs and they still have to take their RMDs and they complain about it because they have to pay taxes on it. I'd rather be in that situation than not have it, but
so it's not as big a deal.
It's not a huge deal, but it does help, and it is effective for beneficiaries because they have a new table, and the whole thing stems from the idea that over the past 20 years, our life expectancy has grown longer, and so they reset the life expectancy tables to show that we're living a little longer. The longer the life expectancy, the longer smaller the percentage that has to come out over your life expectancy every year.
Because it has to last longer. The money has to last longer, so they're forcing you to pay taxes on less.
Yes.
Which, I mean, take it out of the IRA. You don't have to spend it. I mean, I don't get it. But anyway.
You take it out, spend it, and have fun.
Or don't. I mean, I don't know.
The qualified charitable distribution is still there. And that's still at age 70 and a half. That number didn't change with the new RMD rules at age 72.
So there are all kinds of planning opportunities, but just some things. Just know that if you've been maxing out your 401k and you didn't realize you can put an extra, $1,000 in if you're
$1,000 in regardless of age.
Well, yeah, you can put an extra $1,000 in, then you can do it.
And for those people turning 50 this year, it doesn't matter when you turn 50. Know that you have that higher limit. I mean, even if your birthday is December 30th. You don't turn 50 until the end of the year.
But you may want to max it out by September.
If you want to max it out, make sure you don't want to have to wait for a check that pays you on December 30th to get the extra $1,000 in there.
Exactly.
So you set it up to put it in for the year. I've very rarely seen people put it in and max it out early. Actually, the only time I've ever seen somebody try to max it out early was back in 2009. I knew somebody who had a spouse that worked and they put 100% of their paycheck into the 401k starting in January. It's January, February, March. I think it was going to take him until March basically to get it all in. And he maxed out his 401k in the first 3 months of the year in 2009. He felt that the market was going to turn around, and it did. In March of 2009.
Wow.
And so all that money he put in, he was buying on sale. There's a sale at pennies.
Exactly. Well, it was a good,
that was a gutsy move at that time because everybody thought it was going lower.
Well, it's all the market timing. Sometimes you can hit it right, but don't expect to.
That was the only time I've seen somebody really try to max it out in the early part of the year.
Social Security. There's a cost of living. Well, that's good.
Right. January payments went up by 5.9%.
That was quite a jump.
Actually, we haven't seen the January payment. Well, if you're listening to this now, you've seen the January payment.
Right. So, it was quite a jump. We haven't seen an increase like that in a while.
1.4, 1.6 for 2021. I mean, it's been in the 1 range for a while. We had a couple zeros a couple years back.
Yeah.
But this is the biggest increase that we've had for quite a long time.
Which is significant because next year's increase, whatever that may be, if there is one, is going to be based on this new number.
Well, yeah, and they go September to September. I mean, the CPI for 2021 was actually 7%. But for the measuring period that they use for Social Security, it was 5.9%.
Yeah.
So we've got a little of a head start because we're some of it towards the end of the year. So next year we could maybe have, unless we see a reduction, a deflation, doubt it, but I don't know. We're probably going to get a decent CPI for next year as well.
Yeah, which is
we're
a good
pretty
thing.
early in this at the time, though.
And so there are people out there who one of the biggest decisions that many retirees have is, when do I start taking my Social Security? We've done podcasts on this before, and there's certain rules of thumb that you might want to follow. But there are people who are concerned in some respects that if they wait to take their Social Security till age 67 or whenever their full retirement age is, and then they only lived age 69, that they made a mistake. Or
Well, then that was a mistake.
or if they took it at age 62,
But they lived to be 100.
and they lived to be,
that was a financial mistake.
Maybe they made a mistake. So I wanted to get into this notion here, and we had a Lucia Capital Group Weekly video about this. And I thought I'd just expand this a little bit here briefly. That Social Security, Professor Plum, is your decision to start taking your benefits doesn't have to be
an irrevocable one.
An irrevocable one, correct. Can you explain how this works for some people who are afraid, or maybe they took it and they regret it?
Well, if we start with the people that take it early but then realize, well, maybe I should not have taken it for whatever reason, we all have basically a 1-year window that we can change our mind. If we start taking it, because we can still take it as early as 62 or as late as age 70, and it'll grow for every month that we wait between those 2 months. If we start it early and then decide that we shouldn't have for whatever reason, we can call a mulligan and do a do-over. Pay back what we've already been paid, the gross payment of what we've been paid over the up to 12 months of benefits that we've received, and then act as if we'd never started. Now, we can only do this once, but for somebody who starts and then realizes maybe they should have waited, maybe they, for whatever reason, they decide that, there's a one-time mulligan to repay up to 12 months of benefits. If you're 13, 14, 15 months into it, you cannot do this. You have to do it within the first rolling 12 months of receiving your benefits.
So you can just say, as if it pretend it never happened.
Paperwork to fill out. Yeah.
Yeah. Well, yeah, but it's sort of a pretend it never happened kind of thing, and then your benefits would continue to grow.
Well, it's as if you never took it.
I knew of somebody one time who had inherited some money at age 62 and a half or something that didn't expect to get it, and now they had enough that they didn't need the Social Security, and so they wound up saying, okay, well, let's pay it back. And
back in the 90s and back when interest rates were a little higher, some people saw this as a way to game the system, where they would start it and then take the benefit and put it in a bank account and earn 4 or 5% back when you could do that. And then at the 12th month, pay it all back, but you only had to pay back the raw amount that they paid you, no earnings on it. And so that was a lot of work to get, and now you're not earning anything on safe money.
Well, it was, and you're only earning what's in the account. So, but it's not like you put a lump sum in. I don't know. But anyway, so you can. So
if you've started it and you change your mind in the first 12 months, you can undo it as if it had never started.
You can do that at any age. It doesn't matter whether it's 62, but you can only do it one time. Is that right?
One time, yeah. You can't do it at 62, pay it back at 63, and then start it again at 64 and pay it back at 65, and you just keep changing your mind. No, you can only be wishy-washy once.
So, the reward for waiting is, for every month that you wait, you get
roughly 8%, or not? Roughly an annualized 8%.
Yeah, about 8%. So for every month, it's whatever that is, 8/12. What
2/3.
2/3. Okay, 2/3.
And that's not a constant, because there's different numbers between 62 and 63 or 64 and 64 to 67, depending upon when you're. So the only constant is from full retirement age to which is 70 is where we have a constant. It's an 8% annualized,
which is what I want to get into, because let's say somebody reaches full retirement age, which for many of us now is like 67, who can make this decision. They get to full retirement age and they think, okay, look, here's the deal. I don't know how long I'm going to live, but man, waiting.
I'm feeling pretty good today.
I'm feeling pretty good, and I'd sure like to wait. Because the reward for waiting from full retirement age seems to be a little bit better than it was waiting at age 62.
A little bit.
So I'd sure like to, but man, I don't know what to do, because if I live only till age 70 or something happens, I get bad news from the doc, I don't want to miss out on this. So it becomes sort of there's
Well, you can change your mind in this aspect as well. Before we talked about starting it and changing your mind that you didn't want it. This is where you're pretending to, or you're thinking that you want to defer it, but then for whatever reason, you decide this isn't working. My budget doesn't feel good. My health doesn't feel good. I want to change my mind and take it from an earlier date.
Well, yeah.
There is a one-time ability to retroactively go back 6 months, not 12 like the other one.
Yeah.
This is a 6-month deal. So if my full retirement age is 66 and I start my benefit at 66, when I turn 66 and a half, I can say, you know what? I should have taken it at 66. I want to go back and retroactively apply for it from 6 months ago. Start receiving that benefit. It's not the higher benefit anymore. It's the age 66 benefit. And I've missed 6 payments. Give me a lump sum check for that 6 payments that I missed. And they will do that.
Which they will do. They can give you, so once you hit the 6-month mark after your full retirement age, you can make a decision. And this is what I like about this, Professor Plum, because if you're one of those people who isn't sure, I don't know maybe I need the money. I don't really know, but I'd love to let it grow. But I don't want to make an irrevocable decision now and regret it, because at age 70, I'm still running marathons and I should have waited and I'm going to live to be 95. So how do you look at this as a series of 6-month?
Well, you just reevaluate every 6 months. Should I have deferred? And if the answer for whatever reason changes, a different income need happens. Maybe you got married to a younger spouse and you want, or you got divorced and you don't care about, I don't know. There's different reasons to do things. And every 6 months you just evaluate and say, should I still be deferring? If my answer has changed, I have a 6-month retroactive I can go back on.
So what you can say is at age, now mine is at age 67, so I'll take it from age 67, which is
your
still
full retirement age,
right? Which is still a little ways away. So if at age
closer every day,
I have waited, let's say that's true, till age 67. So I'll say, well, I'm going to wait 6 months. I'm not going to take it at age 60. I'd like to,
and reevaluate.
And then so 6 months later, I say, okay, well, I'm okay right now.
The budget's okay.
Yeah, we're good. My health seems to be okay. So I'm not going to take it yet. I'm going to wait another 6 months, which I do. Now I be age 68.
Now you reevaluate it again.
And I look back and I say, well, did it work? Well, yeah. On the other hand.
Or maybe the budget really, I really don't like my budget right now. And if I were taking my Social Security, it would just feel a lot better. And so,
yeah, it would help. It would help if I actually had these payments. And so I should have taken it. I made a mistake.
I can go back 6 months and pick up that 6-month retroactivity.
Yeah. I mean, from a financial standpoint, maybe it makes a difference. But I think from a psychological standpoint, when you make a pension decision,
it's irrevocable for most part.
It really is. I mean, I guess there are situations where you can change it. But
I've seen very rare instances that you can change it. Some of the state pensions, when there's a death, maybe you had a survivor option with a spouse, and the spouse died before you.
Yeah.
Maybe I've seen this where they could put a child in as the beneficiary. Now it reevaluates your pension check down quite a bit, but it continues for the child when you die. So I've actually seen that happen once. Interestingly enough.
Wow. But you should probably consider a pension decision.
Especially in the public or private arena.
Yeah.
It's pretty much an irrevocable decision.
Well, so this just may be one way to do this, one way to look at this Social Security decision. I found it fascinating, and I just wanted to kind of
hope you do too.
Yes, I hope you do too. One other thing here that we can talk about, because I mentioned pensions here, is the old lump sum versus annuity.
And lump sums still are very attractive for
decision.
many cases.
Explain what the thought process is for people who are trying to decide whether they want to take that lump sum or take an annuity. Because depending on interest rates, Professor Plum, that lump sum amount...
The lower the interest rate, the better the lump sum.
Yeah.
The higher the interest rate, the less the lump sum would be. And this is all driven by the monthly pension that you would normally get at retirement. The lump sum is a function of that payment. The payment is not a function of the lump sum. They calculate the lump sum off the payment. And so you have earned a payment of X when you retire. And so you can now choose to take a life-only option. You can choose to take a joint and survivor option. If you're married, you have to unless they sign off, or different levels of joint and survivor. You can, there's different options. And one of the options in some cases, not every case, is to separate from the pension and take a lump sum amount of money. So the question is, can you take that lump sum of money and create a more efficient payment for yourself that fits your needs better? Maybe you want to spend more money in the early years, and you faster than what you would be doing, you'll spend less in the later years. Or maybe the lump sum is just nice enough to say that I'd rather have that because I think I can do better than what they're paying me out. And so but it all depends on what it is that's happening in your life and how good of an investor and how sophisticated you are and how competent you are in handling and not emotionally overspending. Unfortunately, I've seen where people took the lump sum and it was a large lump sum that seemed like just an unstoppable amount of money, and they picked up some spending habits they'd never had in their lives.
Well, where do we see this most often? You read about it is in lottery winnings. I mean, how many times
winners, the statistics on them is horrible.
They give you the option in most cases, I believe. They give you an option to take a lesser lump sum.
Well, of course it's lesser because it's the present value of the future payments.
So take the lump sum or take 20, 30 years, whatever it is, of annuity payments. I mean, people from what I've read take the lump sum. Now, it's not quite the same, but the principle is the same. And so you say, well, gee, all of a sudden I've got all this money. Is it going to last? And unfortunately for many lottery winners, the answer is no.
They spend it like crazy people.
Yeah.
And when you have that, $1 million instead of, $4,000 a month, it's like, well, $1 million is never going to be able to spend that down. Yeah, you can.
You can, and it's dangerous. So just very quickly, because I know we're running out of time here. When you're trying to make a decision as to a lump sum versus an annuity payment, Professor Plum, just very quickly, what are some things that you need to think about? You said maybe your own objective.
Well, your objectives, your ability to be disciplined with your distribution strategy, how you want to set it up, your risk tolerance, because the only way to beat the payment from the monthly payment would be to take at least some amount of risk. You can't just put it in the bank and get the same payout for the period of time. Your life expectancy, to some degree. I mean, obviously, if you've got a life expectancy of 120, 130, the pension is probably a pretty good deal because it'll keep paying for the whole time and you don't have to worry about the investment. Yeah, and some of it is, do you want to have to worry about the investment? One of them is, one's a guaranteed payment. You don't have to worry about it. It's guaranteed by the PBGC as long as you're within limits.
Well, that's true.
The other is you're in charge of it now. So those are the big factors. But sometimes it's, do you need that monthly payment? I've seen people that have a pension, married couple. One person has a very good pension. The other person has a pension, but they take the lump sum from the lesser one because they've got, between Social Security and the pensions from the one spouse, they've got plenty of income coming in and they want to be able to buy a boat or do something, big ticket items early rather than make payments. And other people are like, I don't want to deal with it. Just give me a monthly check because I'm good with that. I'm comfortable with that. I've been living on a monthly check for my entire working life. It'll make my life a lot easier. And having a certain amount of guaranteed monthly income is a godsend in many situations.
Oh, yeah.
But you have to look at, sometimes the lump sums are just too tempting and sometimes they're not. A lot of state employers, teachers, they have a lump sum option. And unless they're terminal, it's a horrible option because it doesn't represent the same actuarial equivalent of the present value of the payments.
Yeah.
I don't want to get into the math on that, but sometimes it makes sense and sometimes it doesn't.
Which is why you should talk to a financial advisor about this stuff because they can help you run through the numbers. Professor Plum is good at this stuff. Any of the advisors at Lucia Capital Group can help you out. Do you want to know when to start taking Social Security? I mean, what is the best age for you? What about this whole pension decision? What should you do?
I was talking to somebody last evening about buying back time in a state pension. He was thinking, should I buy those other 4 years that I could potentially buy back for a cost of X? And as it turned out, he was basically putting in X and he was going to get back a quarter of X in an increased pension for the rest of his life. So it was a 4-year break even.
Well, live 4 years.
And I said, do you think you can live 4 years? He's like, I sure hope so. And he was
Well-
going to take a survivor benefit anyway for him and his spouse. So
Yeah.
as long as both of you live 4 years, this is a good deal.
Well, gosh all hemlock, Mr. Science. What a great idea.
Now, it doesn't always work that well.
Well, no, it doesn't. There's no guarantee it's going to work that well. And
lump sums are different. I know that I worked
absolutely.
on another one a couple years ago that it was like, even with the similar pension, it was a state pension, it was a 9-year break even instead of a 4-year break even.
Well, you can't
Still
guarantee.
pretty good.
Well, but still, 9 years. I mean, anything can happen in 9 years, which is why you should have an advisor talk to you about this stuff. 800-644-1150, the number at Lucia Capital Group. They do this. You guys do this all the time. You advisors.
Oh, yeah. This is the fun stuff.
This is the fun stuff. And we said in yesterday's show or last week's show why you got into this, because this is the fun stuff.
I enjoy doing it.
This is math, but it's fun math.
Yeah, it's not calculus.
No, it's not. E to the X, dy, dx. You can give them a call, 800-644-1150. Talk to any of the Lucia Capital Group advisors. They'll help you out. They all work under and with Professor Rick Plum, who oversees all the financial plans that go out. So talk to him and get these numbers as best you can. 800-644-1150. Anything else before we close?
No, I was just thinking my son-in-law is a mechanical engineer, and that is not fun math. He thinks it's fun, but that's not fun math to me.
No, I turn and run. I turn and run.
Gosh,
no.
what he's creating is wild.
Well, you know what? Hey, God bless him, right?
Yes.
Good. Leave me out of it, but go for it. You can also check us out, luciacap.com, luciacap.com, and find all the stuff online. You can contact us that way. And Spotify. Don't forget, go to Spotify, subscribe to our show, download it every single week, and you will never miss a single program. My thanks again to Professor Rick Plum, certified financial planner professional. I'm Johnny Dean for him and the rest of the gang at Lucia Capital Group. Thanks so much. It's been Managing Your Financial Future. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License number 0518721. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.